In April this year, the price of a gallon of regular gasoline in the United States went like this: 4.06 on April 1st, 4.11 by mid-month, 4.03 for the week of April 23rd, a small break, then on April 30th, $4.27. A 27-cent jump in 7 days. A year ago that same gallon cost $3.17, more than $1 lower than today. That's the Iran war. Every government announcement about it moves the pump price within hours. But here's what didn't make the headline. The week prices fell when gas dropped to $4.03. That drop happened because on April 21st, President Trump extended the Iran ceasefire indefinitely. And 15 minutes before he said so, someone placed a $430 million bet that oil was about to fall. They were right. Again. This spring that has happened 4 times, 4 announcements, 4 massive bets placed minutes before, $2.7 billion total, everyone perfectly timed. You found out when Trump posted on Truth Social. Someone found out earlier. This video is about how that's possible and what it tells you about every market you watch. One quick note: subscribe for weekly market breakdowns. Hit like if this is useful. Drop a market in the comments, those become entire videos. Now back to it. Now, you know the rough shape of why oil moves right now. The Iran war started in late February. Iran closed the Strait of Hormuz to unfriendly nations by March 2nd. Brent crude went from $72 to $126 in 6 weeks. Gasoline at the pump went from $3.10 to $4.27. That part you've already heard. What you haven't heard is this. In each of the 4 windows when the war made big news and the price moved hard, someone moved harder earlier and in exactly the right direction. $2.7 billion right. Today we're going to look at how that happened. And then we're going to look at what it tells you about every other market you watch. Now, between late March and late April this year, the U.S. government, and in one case, the Iranian government, made 4 major announcements that moved oil prices sharply. Each time, prices moved. And each time, someone had already positioned for exactly that move. Here is what that looked like in sequence. March 23rd. Oil had been above $100 for 3 weeks. At roughly 9 in the morning Eastern Time, trading volume in crude oil futures spiked dramatically, with no news to explain it. $580 million worth of bearish positions entered the market in a 16-minute window. The volume in that minute alone was 9 times the typical hourly average. Then, at 9:16, President Trump posted on Truth Social. He announced that the United States had begun productive conversations with Iran and would pause planned strikes on Iranian energy infrastructure. Oil dropped 15% that day. The traders who placed those bets in the 16-minute window made returns estimated in the hundreds of millions. Nobel laureate economist Paul Krugman, writing in Fortune the next morning, flagged this trade as a structural concern, not an isolated scandal of one rogue actor, but a sign that classified U.S. policy decisions were now propagating into markets faster than the public could learn about them. That observation is the frame for the rest of this video. April 7th. 2 weeks later, hours before any public announcement, $950 million in bearish oil bets accumulated across CME and ICE exchanges. At 6:30 that evening, Trump announced a 2-week ceasefire with Iran. Oil fell 15%. The size of that single trade is larger than the annual revenue of most S&P 500 mid-cap companies. It was placed in the span of a few hours. It was correct. April 17th. 10 days after that, $760 million in bearish positions appeared in the market. 20 minutes later, Iran, not the United States, announced the partial reopening of the Strait of Hormuz. Pause on that one. That trade anticipated a sovereign decision by a foreign government about its own waterway. Hold on to it. We are coming back to it. April 21st, Tuesday evening. Between 7:54 and 7:56 p.m. Greenwich Mean Time, traders sold 4,260 lots of crude oil, $430 million in 2 minutes. At 8:10 p.m., 14 minutes later, President Trump announced the ceasefire would be extended indefinitely. Oil fell again. 4 announcements, 4 distinct dates, 4 perfectly timed bets, $2.7 billion in total exposure. The probability of getting the direction right 4 times in markets that respond to thousands of variables is not zero, but it is small. The question regulators are now asking is what explains the rest of that probability. The answer, and this is the part most coverage has missed, is structural. And to see it, we are going to walk back through the biggest of the 4 trades, minute by minute. Take April 7th, the biggest of the 4 trades. At 6:30 in the evening Eastern Time, President Trump posted a 2-week ceasefire with Iran. Within hours, oil prices fell 15%, but by 6:30, $950 million had already moved against oil. To understand why, you have to walk back through the day and the weeks before it. Start with what was already happening. For the previous 5 weeks, since Iran shut the Strait of Hormuz on March 2nd, marine war risk insurance premiums for tanker transits had been elevated. Lloyd's of London publishes weekly bulletins on these premiums. By early April, premiums had climbed from 0.125% of insured value to between 0.2 and 0.4%, a 3-fold increase. For a single very large crude carrier voyage through Hormuz, that meant approximately $250,000 additional in cost. That signal, sustained, public, and quietly priced into every barrel of oil shipped from the Gulf, had been visible for weeks. Most retail investors had never read a Lloyd's bulletin. Now move forward into the morning of April 7th. Through the morning, oil futures traded inside a narrow range. Brent crude held near $110. Volume was steady, nothing unusual. Then in the afternoon, something changed. Across CME Group and the Intercontinental Exchange, bearish positions began accumulating. Not gradually. By the close of the trading day, approximately $950 million in bearish oil bets had been placed. That activity left a clear footprint in the volume tape, a footprint visible to anyone watching CME data in real time. The CFTC publishes its weekly commitments of traders report every Friday, summarizing how positions are weighted. That data is free. It is delayed by 3 days. Almost no retail investor reads it. Meanwhile, on Polymarket, the prediction market platform where users bet on real-world events, something unusual was developing. In the hours before Trump's evening announcement, at least 50 newly created Polymarket accounts placed substantial bets that the United States and Iran would reach an agreement. One wallet, opened the same day, made $200,000 on those bets. Another, opened the day before, made $125,500. Total flow on ceasefire-related contracts crossed $170 million. Every wallet creation, every bet, every payout, all of it was visible on-chain. Polymarket's ledger is public. Anyone with an internet connection could have watched it happen. Then at 6:30 p.m., Trump posted on Truth Social. The 2-week ceasefire was public. Oil dropped 15% over the trading session that followed. Within an hour, Reuters had a wire report. Within 2 hours, CNN, Bloomberg, and the AP had picked it up. 4 to 7 days later, AAA's weekly survey of gasoline prices began to reflect a small dip. That was the slowest, lowest resolution echo of a chain that had been moving for weeks before any retail investor saw a headline. Now step back from April 7th and look at what just happened. In the hours, days, and weeks before Trump posted, 5 different markets had already repriced. The insurance market slowly and quietly over weeks. The futures market sharply that afternoon. The prediction market visibly in the hours before. The news media within minutes of the post. And finally, the gasoline pump a week later. 3 of those 5, the futures footprint, the Polymarket wallets, and the Lloyd's bulletins were publicly observable in real time by anyone who knew where to look. The trade that won $950 million on April 7 did not necessarily come from inside a classified room. It could have come from someone watching the public layers more carefully than the rest of the market. That is the structural pattern these four trades exposed. Not corruption, not a unique conspiracy. Just a faster reading of the layered way information actually moves through markets. There is, however, one trade this reading does not fully explain. April 17th. The $760 million bet on the Iranian Hormuz announcement preceded even the insurance market repricing. That information was upstream of every visible layer. That is what the CFTC is most interested in. Because once a trade beats the public layers, it can only have come from somewhere they can't see. The White House noticed. On March 24th, the morning after Trump's first Iran post, the administration issued an internal memo warning staff not to use non-public information to place bets on prediction markets. You don't issue that memo if you're confident no one is doing it. But the bigger development came earlier in the year. In January, U.S. forces executed Operation Absolute Resolve, the special forces raid that captured Venezuelan President Nicolás Maduro. One of the soldiers involved, identified by federal prosecutors as Gannon Ken Van Dyke, used his classified knowledge of the operation to place 13 Polymarket bets in the week leading up to the raid. He wagered approximately $33,000. He won $410,000. That is a 12-to-1 return, generated entirely by knowing what the public didn't. When journalists started asking questions about unusual Maduro-related trading on Polymarket, Van Dyke tried to delete his account, telling the platform he had lost access to his email address. He was charged in April with theft of non-public government information, commodities fraud, wire fraud, and 4 other counts. It is the first time the Department of Justice has ever prosecuted a case of insider trading on a prediction market. The legal mechanism exists. It is now being tested at this scale. Now, so what does this mean for the person paying $4.27 at the pump? It means the price you see is the last in a chain, and it means 3 parts of that chain are publicly observable for free by anyone right now. You don't need a Bloomberg terminal. You need to know they exist. The first is for energy specifically. The CFTC's Commitments of Traders report. Every Friday, the agency publishes a breakdown of how futures positions across crude, natural gas, agricultural commodities, and currencies are weighted. Producers, hedge funds, retail traders, you can see who is positioned which way. The data is free. It is delayed by 3 days. That delay is the only edge institutional traders still have over you, and it is small. The second is for everything else you might own. The options market. Every public stock has options listed on it, and every options chain shows you the same thing the COT report shows for futures, who is positioned which way, weighted by money at risk. Implied volatility, unusual call or put activity, the put-call ratio, all visible on most retail brokers in real time. Unusual options activity has been a leading indicator of corporate news for decades. The third is for political and geopolitical events, prediction markets. Polymarket and Kalshi let you see in real time what informed people are betting on: election outcomes, ceasefire probabilities, central bank decisions, Supreme Court rulings. The wallets are public. The flow is public. You don't have to bet to watch. These 3 tools will not make you a hedge fund manager. They will not give you alpha by themselves. What they will do is make you less surprised. Most retail losses come from being surprised by news that smart money already priced in. Surprise is expensive. Watching these layers is how you get less of it. So, the CFTC's response to the Senate Banking Committee on the 4 oil trades was due last Thursday. What that agency says next will determine whether this story moves to prosecution or quietly closes. That outcome will be visible on the news. But the structural pattern, the layered way information actually moves through markets, That doesn't depend on the prosecution outcome. That is just how the market works, and now you know it. March 23rd, April 7th, April 17th, April 21st. Each time, multiple markets repriced before the president, or, in one case, the Iranian government posted anything publicly. 3 of those markets are accessible to you right now for free. The next time gas prices move and you don't know why, which one will you check first? The next time you fill your tank, look at the number twice. Once for what it costs you, and once for what it tells you about the markets that moved before it did. 3 tools, free, public. If you found this useful, hit subscribe and tell us which one you'll check first in the comments.